Welcome back to Investing Talk podcast.
Today, we are counting down the top 5 stock to buy right now, based on our latest research. Our focus today is on companies that are either undergoing, massive strategic pivots or banking on high-stakes near-term catalysts.
This is a big one. Before we get to our first pick, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, let's start the countdown. We're beginning this list with a look at strategic expansion in the biotech sector. What's the first company on our list?
First up is Mankind Corporation. The reason it's standing out is the combination of strategic expansion and strong financial momentum. It really suggests they are successfully diversifying beyond their traditional niche.
Yeah, you really can't argue with the recent numbers. That Q3 2025 earnings report was pretty phenomenal.
Phenomenal is right. That EPS beat was huge, 0.07 cents versus the forecast of 0.02 cents.
That's exactly. Hitting a 250% earnings beat while also delivering 17% year-over-year revenue growth. Well, in a market segment as volatile as specialty biotech, that's seriously impressive.
Absolutely. And the revenue is stabilized by two key products. You've got sustained sales of their core inhaled diabetes system, Afrezza, and then the royalties from Tyvaso DPI, for pulmonary hypertension. These are complex, established markets.
Right. But the real inflection point for them, I think, was the recent completion of the acquisition of SE Pharmaceuticals.
Yes.
This is where the story shifts from, stable performance to a really aggressive growth strategy.
It fundamentally changes their market narrative, doesn't it? That acquisition added the Furoscix product line. So while Afrezza and Tyvaso focused on respiratory metabolic diseases, Furoscix is it's a subcutaneous loop diuretic. It targets fluid overload in the cardiorenal market.
And that move is critical because the cardiorenal market, so diseases relating to the heart and kidneys, it's enormous, it's growing, and it's driven by chronic conditions that, well, they require long-term adherence. It immediately expands their total addressable market, gives them an entirely new portfolio. The strategic value is massive. But, it comes with integration risk.
Definitely integration risk. So near term, investors are watching, I'd say, two immediate signals. First, the highly anticipated Q4 earnings report, which is expected in February 2026.
Okay.
But perhaps more telling will be the updates on the integration and the commercial scale-up of those new SC Pharmaceuticals assets. We should hear about that in December 2025.
That makes sense. Successfully integrating a whole new product line and sales force, that's really the key to unlocking that long-term potential.
Exactly.
Okay, that's a great look at a high-growth biotech. Interesting. Moving on, my pick for the next one is IN. Now, this is an entirely different kind of story. This one's all about the power of the pivot, that massive shift from pure energy-intensive Bitcoin mining to AI infrastructure.
That pivot is the reason we're discussing them, isn't it? We've seen several miners attempt this shift, but IRN seems to have executed it exceptionally well. It's resulted in just an exceptional financial turnaround.
What's fascinating here is just the sheer velocity of that shift. They successfully transitioned to focusing on AI cloud services. And just look at the numbers. They reported a record Q1 FY26 revenue of $240.3 million. That is a staggering jump.
Staggering doesn't even cover it. That's up 355% year over year. And crucially, it translated to profitability.
Yeah.
Net income surged dramatically to $384.6 million in that quarter. This is a complete, re-rating of the company from a speculative energy play to a high-margin service provider.
And that transition gives them a significant competitive moat that goes beyond just the quarterly revenue numbers. They secured that landmark $9.7 billion AI cloud contract with Microsoft.
Huge.
That contract doesn't just provide revenue, it serves as a massive financial anchor. It de-risks their long-term stability and, importantly, validates their technical capability.
Exactly. It shows they can compete at the hyperscale level. And they are aggressively deploying 140,000 GPUs, effectively turning their physical infrastructure, which was once, solely focused on mining, into a premier platform for serving the AI supply chain.
But this raises an important question, though. Can they sustain this level? The market for AI infrastructure is highly competitive, very capital intensive. We need to see not just this initial growth, but, the replication of the model.
Yeah, and if we connect this to the bigger picture, that's exactly the near-term catalyst everyone is watching, besides the upcoming earnings, of course.
Right.
There is significant speculation regarding new, large, hyperscale client deals that might follow the success of the Microsoft contract. If they prove they can replicate that kind of deal flow, well, the upside is substantial because they become like a foundational piece of the whole AI ecosystem.
Have a very different risk profile for mankind. Okay, moving from digital infrastructure back to the high-stakes world of clinical trials.
Yes, saw
This
that.
is where the risk is highest, but the potential return is, well, staggering. What's our third stock?
Third on the list is Capricorn Therapeutics. This choice is based almost entirely on extreme high-risk, high-reward analyst consensus. The average price targets are hovering around $22.25.
Wow.
Yeah, suggesting over 216% upside potential from current levels. This is strictly for the investor comfortable with, let's call it, binary risk.
Okay, 216% potential upside definitely signals high risk. That's why we need to look at why analysts are comfortable with that kind of extreme volatility. It all hinges on their lead program, Diversify.
Duramyocel is the potential game changer here. It's an allogeneic cell therapy, targets inflammation and fibrosis in the heart muscle, and it is currently in phase 3 clinical development for Duchenne muscular dystrophy, or DMD.
And DMD is just a devastating, fatal genetic disorder, primarily affects young males, causes progressive muscle weakness. It represents a major high-need market where any significant therapeutic success will be met immediately with strong market enthusiasm, maybe even fast-track approval.
Absolutely. But the risk cannot be overstated here. Recent analyst EPS revisions have actually been negative, reflecting cash burn associated with these late-stage trials.
That makes sense.
The volatility is just baked in because the bullish rating is purely predicated on successful clinical execution. If that phase 3 data disappoints, the stock could, well, collapse. It's a true lottery ticket kind of setup.
Which makes the upcoming catalysts absolutely critical. Investors will be focused on the Q3 earnings release on November 10th, mostly to check their burn rate, I imagine.
Yeah.
But the real focus, the real make-or-break moment, will be that crucial holiday pipeline progress report on Diversify, expected on December 24th.
Right, Christmas Eve. That clinical update will be absolutely pivotal in shaping investor confidence for the entire next year.
All right, so from the high-stakes world of clinical trials, let's pivot again to another area of AI that is really disrupting daily life, conversational intelligence. What's your fourth pick?
My pick here is SoundHound AI. This is more of a classic growth story, I think, underpinned by robust market penetration in the conversational AI sector. Their platform doesn't just listen, it actually understands context, which enables deep integration across multiple industries.
And the growth metrics really back that claim up. They seem to be moving out of that early-stage hype phase and into explosive operational growth. Their revenue surged, what was it, 84.6% year over year in 2024.
Yeah, almost 85%.
And management is confident enough in their product mode to have recently raised their 2025 revenue guidance to $180 million. That raised guidance is a powerful signal, isn't it?
It really is. And their market moat comes from their kind of horizontal strategy. They aren't tied to one single product. Their technology is integrated across automotive systems, IoT devices, and crucially, the quick service restaurant sector.
Ah, the restaurant vertical. That's particularly interesting because it offers such rapid scale potential.
Yeah.
They recently surpassed 14,000 active restaurant locations, and they announced that significant partnership with Red Lobster, using AI to take drive-through and phone orders. This creates highly sticky, recurring service revenue.
And the more they process, the better their AI gets, which just deepens their competitive advantage over time.
Right, the network effect. And despite being a high-growth company, they seem to maintain a healthy balance sheet. They reported $269 million in cash at the end of the last quarter.
That financial strength is key. It allows them to continue R&D investment and pursue new large enterprise partnerships without, worrying about immediate capital raises.
So the catalysts here sound pretty concrete and tied directly to their deal-making capacity.
Yeah, exactly. Management has guided toward multiple large enterprise deal announcements slated for late Q4 and early Q1. If those materialize alongside the Q4 earnings release expected in January 2026, we could see some swift positive price movement as the market recognizes that broadening commercial reach.
Okay, makes sense. That brings us to our final stock, focusing on the disruption of a very old, very resistant industry, insurance.
And our fifth stock is Lemonade. The key rationale here is their use of a digital-first model and proprietary AI, what they call Lemonade 2.0, to really try and disrupt traditional insurance models. They are successfully driving 30% year-over-year revenue growth, which is pretty solid.
And Lemonade 2.0 isn't just about a slick app, right? It's really about the claims process itself. Their AI uses behavioral economics, massive data sets, apparently handles claims in seconds.
Theoretically, yeah.
Yeah.
Reducing fraud and processing costs much faster than legacy carriers who, rely on armies of human adjusters.
What's fascinating here is their visible path to profitability, though it's still challenging, obviously. They're demonstrating operating leverage. Their operating loss narrowed by 21% year over year.
That's a good sign.
And management forecasts they will reach positive adjusted EBITDA by the end of 2026. This is the timeline the street is watching intensely. Can a digital disruptor actually make money in insurance? It's the big question.
And we're seeing strong confidence signals from those closest to the company, suggesting, well, they believe that timeline is achievable. Institutional ownership is over 65%, which shows broad trust.
Okay.
Plus, we saw net insider purchases of approximately 45,000 shares back in September and October 2025. Both the CEO and the CFO putting skin in the game.
Insider buying is always interesting. So upcoming catalysts include the Q3 earnings report on November 14th. That'll give the latest update on their loss ratios, which is key for insurance.
Very key.
Investors are also eagerly watching for the imminent rollout of the Lemonade Car 2.0 software upgrade. That's aimed at boosting cross-sales and improving their telematics data, I believe.
Right. And then there is the less confirmed but kind of persistent speculation about a significant European partnership announcement sometime in Q4 2025.
Yeah, international expansion.
Yeah, if they can successfully expand their footprint internationally, it significantly de-risks their reliance on the, let's face it, very competitive U.S. market.
That's quite a powerful list of companies, each one relying on a distinct market catalyst, really, to define their next growth phase.
So to recap, our 5 stocks to watch are Mankind Corporation, which is successfully pivoting into that cardiorenal market. Iron, riding the massive wave of the AI infrastructure pivot. Capricorn Therapeutics, offering significant binary upside based on phase 3 trial results. SoundHound AI, deepening its conversational intelligence mode across multiple sectors. And Lemonade, seeking that long-awaited profitability milestone through its proprietary AI platform.
A solid list. If we zoom out, the common thread running through all 5 is that they are really at an inflection point. A major operational or clinical hurdle must be cleared in, the next 90 days or so for most of them. For you, the listener, understanding these specific catalysts is crucial for timing any potential entry. It raises an important question. In today's higher interest rate environment, are you more willing to bet on the stability of a strategic acquisition, like Mankind, or the potentially massive but frankly unstable returns of a high-stakes clinical trial, like Capricorn? That risk tolerance really defines your strategy here. As always, do your own research before making any investment decisions. Thanks for tuning in.